Good afternoon, friends. I welcome you to this virtual CPE meeting on standards on auditing, special areas, and review engagements. Though I cannot see anybody other than those in the panel, but I can understand that there would be a smile and very relaxed faces at this webinar because of the extension on the direct tax as well as on the indirect tax front that our fraternity and we have got, and I understand that we were under tremendous pressure in the with the last week remaining and a lot of compliances to do. But I would say on behalf of WRC and on behalf of all the practicing members, or I would say fellow members, that let us now all work hard to ensure that there is no further request or requirement for a further extension from what the government has already given to us. Friends, we were just discussing before we went live that WRC standards on audit has been a thrust area under the leadership of Lalit Bhai this year, and we propose to have at least, I'm saying at least 24 hours of CPE learning just on the standards on auditing. Accounting standards, Ind AS, that is over and above the standards on auditing. And I would say that this is our sixth CPE meeting, which would mean that we would have completed almost by the end of this webinar 18 hours of auditing standards at WRC for this year. I will now request, sorry, I forgot that I have with me definitely the chairman of WRC, CA Lalit Bajaj, the speaker for the first session, CA Veena Pillai, coordinators, CA Dharmendra Ji Malik, CA Hitar Desai, and I would also recognize the second speaker for the day, CA Pratik Khandelwal, who would be joining us subsequently. I would now request Lalit Bhai to kindly give his opening remarks.
Thank you, Vishal Bhai. Veena Pillai ji, Pratik Khandelwal ji, expert speakers for the day. My regional council colleague Vishal Bhai, and expert on the subject, coordinators Dharmender ji and Hitar, seniors, friends and colleagues. Let me at the outset welcome all of you in this August gathering. As Vishal Bhai has already shared that we are feeling somewhat relaxed after the announcement by CBDT and Ministry. So I believe that we will be able to focus on today's seminar plus other activities which we have kept pending from couple of weeks. Let me compliment Vishal Bhai for organizing such
मिश्रा जी,
हाँ तो देख रहा हूँ शायद
हाँ जरा देखिएगा.
One is we have started with a research forum under the leadership of Vishal Bhai, wherein we have formed a group of say around 300 chartered accountants and then who are interested, and then there is an expert panel advisory group who is steering the whole research activity. What I am trying to tell here is that at WRC, research is being considered as a pivotal activity in the whole arena of the activity of WRC, and I wanted to put it forth very strongly that those all members who are really and seriously interested come ahead in presenting their views or say coming out with some newer ideas in the form of research. I would request you that do write to us at WRC. It is a great forum to work on. Second thing, we are coming out with some basic tools which will help all the chartered accountants to really define as to which section is applicable and as to how it is applicable, whether it is income tax or any other statute which affects our chartered accountants. And I am happy to share that again Vishal Bhai is taking the lead and within say next couple of days we will be launching those tools on WRC website. Those will be freely available for all of you to assess and use to give the best services to our client. With this limited words, I once again welcome all of you and look forward for a very happy learning. Thank you.
Yeah, thank you, Lalit bhai. Friends, the first technical session is on the standards on auditing some special areas, the SA 800 series, which we typically say, SA 800, 805, and 810. And to take us through these three auditing standards, we have a very young speaker, CA Veena Pillai. And I would request my friend Hitarth to kindly introduce the speaker.
Thank you, sir. CA Veena Pillai is an assistant manager for audit and assurance services with Messrs. MSKB and Associates LLP. Her areas of expertise includes statutory and tax audit, quality assurance, and risk management. She also holds a rich industry experience in the areas of technology and manufacturing. With these words of introduction, I welcome CA Veena Pillai to this webinar.
Thank you, Hitarth. I would now request Veena to kindly take charge of the session.
Sure, sir. Just wanted to check, is my screen visible and I'm audible?
Yeah, your screen is visible. You can put it on the presentation mode.
Sure.
Your voice is not very clear, Veena, so try to be near to mouth.
Yeah, sure, sir. First of all, good evening to one and all present. Thank you for the introduction. Thank you, Vishal sir, Lalit sir, Dharmendra sir, Hitarth for coordinating and organizing such a session and providing me an opportunity to present my views on the standards in auditing and specifically the specialized areas, that is SA 800, 805 and 810. Let's begin the session. I'll just
You can
brief you
switch on
through
your
the
camera.
contents that actually, so the net bandwidth connectivity is
Okay,
not
fine,
that
fair.
proper.
I appreciate. You can carry on. Yeah.
Sure, sir. Thank you. Yeah. So, just a brief contents of what will be covered in the session. First would be the introduction as to what are the standards in auditing, how are the standards bifurcated, and specialized focus on the specialized areas. Then, in detail, a discussion on SA 800, 805, and 810, and ending with the auditors reports and auditors report format. Begin with the introduction. So before we get into the main core topic, some basic introduction as to what is standards in auditing. As we all are aware that auditing standards prescribes the auditing considerations that has to be undertaken by the auditor while auditing the financial statement. It provides what are the bases to be considered and what are the things to be kept in mind while auditing a financial statement. So the auditing standards are formulated by the Auditing and Assurance Standards Board and issued under the authority of ICAI. It provides a benchmark against which the performance of the entity can be measured, and it also helps in compliance with the laws and regulations which are applicable in the particular jurisdiction. This represents the best practices that are in the industry as well as in the auditing practice. So it is globally recognized and also accepted since it is based on the international standards in auditing. So this is the brief introduction as to what are the standards, why are the standards introduced, and where it is applicable. Further going into the bifurcation. So standards in all quality control are bifurcated into two, that's assurance services and related services. So related services are comprised of the standards like 4000 to 4699. In the assurance services, it can be classified into two, that's audit and reviews of historical financial information and audit assurance engagements other than the audit or reviews of historical financial information.
Veena,
Yeah.
sorry to interrupt, but are you still on the first slide? Because we can see only the first slide right now.
No, sir, I've moved on to the next slide.
But we can see only the first slide. So, Mishra ji,
हाँ मैडम, हाँ सर,
मैडम का स्लाइड चेंज नहीं हो रहा, एक बार देखिए ना.
हाँ एक मिनट. मैम चेक करो, वापस भेजा है एक बार.
अभी चेंज हो रहा है?
नहीं, अभी आप ऑन स्क्रीन नहीं हो, मतलब आपका स्क्रीन ऑन नहीं, ऑफ है.
स्क्रीन शेयरिंग नहीं हुआ है ना अभी.
मैम आपकी तरफ से स्क्रीन शेयर नहीं हुआ है अभी.
जब मैं क्लिक कर रही हूँ कि क्लिक टू स्टार्ट द स्क्रीन शेयरिंग, उधर मैं क्लिक कर रही हूँ.
हेलो वीना मैम.
हेलो, अभी प्रेजेंट हो रहा है?
नहीं मैम, नहीं. मैम इंटरनेट का कुछ इशू लग रहा है. मैम अभी आया आपका.
अभी आया है ना?
स्क्रीन कर दीजिए उसको.
अभी चेंज हो रहा है स्क्रीन?
हाँ मैम, चेंज हुआ.
ओके. Can I continue, sir?
Yes, please.
Sorry for the interruption. Actually, there's some technical issues. Yeah. So we were on the bifurcation of the standards. So the standards in quality control can be bifurcated into two, that is assurance services and related services. So related services comprises of standards and related services from 4000 to 4699. And then assurance services can be further bifurcated into two, that's audit and reviews of historical financial information, and assurance engagements other than the audits or reviews of historical financial information. The standards that are considered of SAEs, that is standards and assurance engagements from 3000 to 3699, are mainly deals with the prospective financial information, that is 3400 or 3400, that is assurance reports on control of service organization. And then getting into the audit and reviews of historical financial information. That is the topic for today, which will be first session and second session. So it would comprise of standards in auditing, that is from 100 to 899, and the standards of review engagement, 2000 to 2699. So by classification of standards in auditing, that is general purpose framework and special purpose framework. So any financial statements prepared in accordance with the general purpose framework can be considered as a general purpose financial statement. So actually, I'm getting a message that the screen is paused.
Yes ma'am.
I'm getting an error that the screen sharing is paused.
Ma'am, it is on from our side. We'll check again. मैम अभी देखिए वापस.
Yeah. Yeah. So standards on auditing can be classified into two, that general purpose framework and special purpose framework. So any financial statement that is prepared in accordance with the general purpose framework can be termed as a general purpose financial statement. So it is basically from SA 100 to 700. What is exactly general purpose framework?
मैम सॉरी टू इंटरप्ट. मैम आपका स्क्रीन नहीं शेयर नहीं हुआ है अभी तक.
मेरे में इधर स्क्रीन कुछ शेयर करके दिखा रहा है.
मैम वापस ट्राई कीजिए अभी.
अभी आ रहा है? Can you see my screen?
नहीं मैम अभी तक नहीं आया.
Because I'm getting the message that the screen is shared.
मैम अभी आपका प्रेजेंटेशन दिख रहा है. आप म्यूट पे हैं. आप अनम्यूट करो मैम खुद को. ऊपर एक ऑप्शन है
अभी आ
म्यूट.
रहा है. हाँ अभी
हाँ
आ
अभी
रहा है
मैम
आवाज?
दिख रहा है. लेकिन फॉर सेफ साइड आप भेज दीजिए. अगर इनकेस वापस इशू हुआ तो हम लोग यहाँ से प्रेजेंट करेंगे.
ओके.
मिश्रा जी क्या हुआ?
मैम सर उनका प्रेजेंटेशन शेयर नहीं हो रहा है तो हम लोग अपनी साइड पे लेके ट्राई कर रहे हैं.
बट अभी तो वो दिख रहा था ना स्क्रीन.
हाँ वापस चला गया सर. वो इंटरनेट स्पीड की वजह से जा रहा है.
तो उनको ऐसा बोलिए प्रेजेंटेशन मोड नहीं करे और वैसे ही रहने दे पीपीटी मोड में.
ओके ओके.
हाँ बस ऐसे ही रहने. वीना यू कैन डू, वी कैन सी द स्लाइड्स, सो यू कैन कंटिन्यू विद दिस.
Okay. Sure. Yeah. Sorry again for the interruption. Yeah. So we were at the general purpose framework. So what is exactly general purpose framework? So any framework or any financial statement which is designed to meet the common financial information needs of wide range of users. So it is not just restricted to a particular user, but it is directed for the use of public at large. So that is termed as a general purpose framework. It can either be a fair presentation framework or a compliance framework. That is, it is the main objective or the motive is to achieve the fair presentation, or it is to achieve a compliance to the particular law and regulation. So it can be the framework can depend upon the objective. Then coming to the special purpose framework. So this is the topic for today, that is that comprises of SA 800, 805, and 810. So getting to the first detail, that is SA 800, audit of financial statements prepared in accordance with special purpose framework. So what is special purpose financial statement? Any financial statement that is prepared in accordance with special purpose framework. So as we discussed, the general purpose is meant for public at large, but in case of a special purpose framework, it is meant only for to meet the financial information needs of a specific user. That is, it might depend upon who is the user and what is the purpose. It can either be a compliance framework or as a fair presentation framework. Suppose in case an entity might not be required to prepare the entire financial statement as per the applicable laws and regulations in the particular jurisdiction, and it might only be required to prepare a single financial statements to meet the use of a specific user. So it doesn't matter if even in case the user the entity has to prepare only a single financial statement, then that also can be termed as a special purpose financial statement. Related notes would generally include the significant accounting policies and other explanatory notes. An applicable financial reporting framework determines the form and content of the FS. So each financial reporting framework would describe what are the requirements, what are the things to be disclosed and to be complied with each and every regulation. The most common use and applicability that I have seen of SA 800 can be explained with a simple example. Suppose if in case there's a company which is in India and prepares the financial statements as per the laws and regulations applicable in India. Like suppose it follows the Indian accounting standards and prepares its financial according to those standards. However, there is a holding company of the company which is in Singapore. For the purpose of consolidation of the holding company, the Singapore entity would require the financial statements of company A prepared in accordance with the Singapore GAAP. Since the reporting framework applicable over there is the Singapore GAAP, it would require the financial statement as per the GAAP applicable over there. So the auditors of the holding company would request or require the entity to prepare the financial statements as per the Singapore GAAP, and such a financial statement which is prepared for the use of the holding company would be termed as a special purpose financial statement. This is not required as per the rules applicable in India, but it is required for the use of another entity or for a specific user. So that's known as a special purpose financial statement. What would be covered under the SA 800? So it deals with the special consideration in the application of essays to audit of the special financial statements prepared in accordance with the special purpose framework. It is written in complete of the context of the complete set of financial statements prepared in accordance with the special purpose framework. The most important point to consider over here is it does not override the requirements of other standards in auditing. That is to say, even though in the introduction slide it was mentioned that general purpose would comprise of the standards from 100 to 700, it doesn't mean that those standards are not to be applied in the audit of special purpose financial statements. All the relevant standards have to be applied. Like, for example, the auditor of the special purpose financial statement would still have to obtain the audit evidence. They would have to give due considerations to materiality, fraud consideration, risk assessment, written representation, uh, then communication to those charged with governance, sampling, misstatement. So all the standards which are relevant have to be applied even in case of the audit of special purpose financial. SA 800 may not deal with the special consideration relevant in the circumstance of the engagement. What are the objectives of auditor in case of SA 800? So that would be engagement acceptance. What are the considerations in engagement acceptance? Engagement planning and performance, and forming an opinion and reporting on it. So we'll look in detail for each of these topics. First would be the engagement acceptance. As we earlier said that this essay does not override the requirements of other standards. So as per essay 210, that is agreeing to the terms of the engagement, the auditor is required to determine the acceptability of the financial reporting framework. So first, the auditor has to determine the purpose for which the financial statement has been prepared, who is the intended user, and also has to determine the steps taken by the management to see that the applicable financial reporting framework is acceptable. So it cannot be a scenario that the management has just stated that the financial statements has been prepared according to a particular regulation, and the auditor cannot blindly accept that. The auditor has to put in necessary efforts to check whether the auditor has taken reasonable efforts to see that the financial reporting framework is acceptable. Some scenarios that can be used for consideration of the financial reporting framework. Uh, in most of the scenario, the financial reporting framework would be laid down by the regulator or the authority. Like in case in India, the Indian accounting standards have been laid down by the regulator, or in case if suppose the financial special purpose financial statement is prepared pursuant to any contract that is signed by the company and a third party, then the requirements would be specified in the contract itself as to how the accounting has to be done, what are the special requirements, how as to the financial statement preparation. So that has been that would be laid down by the regulator or the authority or the regulation under which the special purpose financial statement is prepared. Suppose in case there is a conflict between the financial reporting standards and and any additional requirement. So there may be a scenario where the auditor come across a situation where uh, the financial reporting framework prescribes any uh, accounting treatment or any auditing consideration which might be in conflict with the generally accepted principles, or any additional requirements are to be stated in the audit of the special purpose financial statement. In such scenario, the auditor has to discuss with the management and analyze what is the nature of the conflict or what is the nature of the additional requirement, whether it is legally acceptable to report on such requirements, and whether the requirements can be mitigated or risk can be mitigated by additional disclosures, and the audited financial statement as well as the auditor's report detailed mentioning about the applicable financial reporting framework. If it is not possible, even after discussion, it is not possible to mitigate the risk even after disclosures, then the auditor has to consider the effect of the same on the reporting. That is, the auditor has to consider giving a modified opinion or adverse opinion or disclaimer of opinion as the case. Next would be another consideration would be suppose the financial reporting frame standards that are laid down by the law and regulation is not acceptable. However, it has to be done because it is prescribed by law. Then there are certain things that is to be kept in mind while the auditor is doing the audit. The first one would be whether additional disclosures would be required in the special purpose financial statement, so that the financial information is not misleading. It is always better to disclose the entire facts and give a detailed description as to what has been followed, so that the user is aware of what is the exact happenings in the company and how is the financial statement prepared. So disclosing the exact facts would not lead to a misleading information. Secondly, the auditor needs to draw attention to of the users to the preparation. So we'll look into the detail as to how the auditor draws his attention to of the users to a particular statement, and usage of the words present fairly in all material respects and give a true and fair. So these two words that are generally used in the opinion paragraph, that is present fairly in all material respects and gives a true and fair. So these are very strong words that we use, and if in case the financial reporting framework are not acceptable, then auditors should restrain themselves from using such terms and only if the law and regulations mandatorily requires to mention these statements, only mention these words, only then the auditor has to use these words, that is present fairly in material respects or give a true and fair. Going ahead regarding the planning and performing the audit. Some of the key considerations is obtaining and obtaining and understanding whether the standards relevant to the audit have been complied and whether the application of the essay requires special consideration. These are the two most important points. I would not say only 2 points. The auditor has to consider many other factors, but the two most important points would be whether the standards relevant to the audit have been complied and whether there are any special considerations to be required. So, as stated earlier, this essay does not override the requirements of other essays, but suppose in case the audit, all the requirements of a standard are not complied with, then what has to be done in such a scenario? Generally, in the auditor's responsibility, the auditor states that uh, the financial statements have been prepared and in compliance with the standards in auditing prescribed under the Act. But if in case all the requirements of the standards are not met with, then the auditor cannot state that the special purpose financial statements complies with the essay. However, if there is any essay which is conditional, which is dependent on the happening of a situation, and if such situation or condition is not met or does not exist, then the requirement can be done away with. The other factor would be the special consideration, which would depend on two factors. That is the purpose for which the financial statement is prepared and who is the intended user of the special purpose financial statement. These are the two very important words in SA 800 as to what is the purpose for which the financial statements is prepared and who is the intended user. For example, if suppose a company wants to avail a loan from a bank, and he goes to the bank and submits his proposal, and then the bank would require a report from the auditor. So bank wants the working capital calculation. In that case, each bank would have its specific requirements as to a certain. Suppose bank A might have a requirement that certain assets and certain current assets and current liabilities are not to be included. They would specify the specific regulation as to what has to be included. In that scenario, the auditor has to specially consider that and prepare the financial statements, report on the financial statements as per the requirements of the particular assignment or particular engagement. Another case would be in case of materiality. As we all know, materiality is a matter of professional judgment, and it has to be in compliance with SA 320. So in case of special purpose financial statement, the auditor has to look at who is the intended user and how will they use the financial statement, how will the matter or things reported in the financial statement be useful for them, and accordingly decide the materiality of the while doing the audit. There might be a scenario where the management might agree with the intended user that certain misstatements or uh, certain audit observations which is below a certain threshold would not be corrected or adjusted. Like suppose the management agrees that any misstatement with below 1,50,000 would not be adjusted. It is the agreement between the management and the intended user. However, the auditor, after performing all his calculation and after applying all the requirements of SA 320, the auditor determines that his materiality is 1 lakh. So that is auditor's materiality is 1 lakh, but the management has agreed with the intended user that any corrections, any misstatement below 1,50,000 would not be accepted. So this is very like a confusing situation for the auditor as to if even if we report, the management would not adjust the mistake. So in such a scenario, even if the management has agreed with the intended user for a particular threshold, this does not relieve the auditor from his or her responsibilities. The auditor still has to apply the materiality as per his calculation after giving consideration to the intended user's purpose, and then use the materiality that has been determined. He or she need not consider the fact that the management would not adjust certain mistakes. Another example could be in case of SA 260, like communication with those charged with governance. So generally, those charged with governance are responsible for overseeing the preparation of the financial statement. But suppose in case the special purpose financial statement is prepared and is intended for solely for the use of management. In that case, this standard, that is SA 260, communicate that is TCWG's responsibility for overseeing the preparation of financial statements might not be applicable, giving the due consideration to other factors. Going ahead with the reporting considerations in SA 800. Yeah. So the reporting considerations, SA 800 specifies that all the requirements of SA 700 revised has to be applied, and all the requirements have to be given consideration to while reporting under SA 800. There are certain elements that has to be present in the reporting under SA 800. First one would be whether the report describes the applicable financial reporting framework. Suppose if the financial statement, special purpose financial statement, is prepared uh, due to the contract signed between the company and a third party, and the contract specifies all the regulations requirements prescribed in the contract, then the auditor has to specifically state those interpretations even in the even in case of the report. Next would be the purpose for which the financial statements are prepared and the intended user. So this is, as discussed earlier, SA 800 specifies that purpose and intended user is very much important, and the report should specifically state what is the purpose for which the financial statements are prepared, and who will be using the financial statements and the auditors. Next would be the management responsibility. In the management responsibility paragraph, the auditor has to state that management is responsible for determining the applicability of the financial reporting framework as well as for the preparation of the special purpose financial statement. In auditor's responsibility, the auditor has to state that if all the requirements of the standards on auditing are met, then in that case, the auditor has to state that the special purpose financial statements have been prepared in accordance with the standards on auditing prescribed under the Act. And last would be the restriction on use. So, since this SA 800 is designed for the use of specific user, we will have to draw the attention of the user to state that this financial statement and this report is intended only for a specific person or a group of people, and if this would not be suitable for any other purpose. So by stating this line, the auditor is restricting its own liability, because we have prepared the financial statements after giving due consideration to all the requirements of a specific user, and after considering the materiality requirements, and all of the audit procedures are designed to meet the specific purpose. So if in case it comes into the use of any other user, then we have to state that this would not be suitable for that purpose, and we would not be liable for any consequences that may arise due to the report being getting into the other hand. So this was a brief idea about SA 800. We would look into the report formats at the end together for the SA 800, 805, and 810. Going ahead with SA 805. So that is audit of single financial statements and specific elements, accounts or items of financial statements. Before we get into the definition, what is a single financial statement and a specific element, account or item of financial statement? suppose the financial statement comprises of the entire set of balance sheet, P&L, cash flow statement, related notes, the statement of changes in equity, and the explanatory notes. So it would run into multiple pages, and there's loads and loads of information included in that. Suppose in case the intended user wants only to see the single financial statement, that is either the balance sheet or the P&L or the cash flow, a single a single financial statement, or a single element from the entire financial statement. That would be a trade receivable, a cash or bank balance, investments, loans and advances. So any report that is issued for a specific element of the entire financial statement would be termed as a specific element, account, or items of the financial statement. So when a report is issued for these single financial statements or a specific element, then the auditor has to consider the requirements of SA 805. We look into the definition. So what is the element of financial statement? Or element means element, account, or item of financial statement. Financial reporting standards, accounting standards issued by ICAR, accounting standards notified by the central government by publishing the same as Companies Accounting Standards Rules 2006, or accounting standards for local bodies issued by ICAR as may be applicable. Single financial statement. A single financial statement, for example, a cash flow statement, or a specific element or a financial statement, for example, cash and bank balance, includes the related notes. The related notes ordinarily comprises a summary of significant accounting policies and other explanatory information relevant to the financial statement or to the element. So what would be included in the scope of SA 805? 805, the SA 800 to 700 series it would be applicable and adopted as necessary in the audit of financial statements, and it deals with the audit of single financial statement and specific elements. As we discussed earlier, this specific SA does not override the requirements of other standards in auditing. So the SA 805 as well does not override the requirements of other standards in auditing. However, 805 would not be applicable to the reports of the component auditor. That is to say, even if in case of a consolidation of financial statements, if the auditor needs to issue a report, then this SA 805 cannot be issued, because for the purpose of consolidation, all the elements of the financial statement, that's the balance sheet, P&L, cash flow, all the things have to be consolidated, and reporting on a single element or a single financial statement would not be applicable. That is the reason why SA 805 would not be applicable to the consolidation or component auditors report. SA 805 deals with a special consideration that may be relevant in circumstances of the engagement. So objectives are similar to SA 800, that is engagement acceptance, engagement planning and performance, and forming opinion and reporting on the standard, SFS and EFS. So for the purpose of ease, SA 805 in SA 805 slides, I have mentioned single financial statement as SFS and specific element, account, and items as EFS. So for the sake of ease and understanding, the SFS would mean a single financial statement and EFS would mean a specific element. So we look into the details for the objectives, that is acceptance, planning and performance, and forming an opinion. Some of the examples would be of SFS or EFS would be accounts receivable, allowance for doubtful accounts receivable, inventory liability for accrued benefits for private pension plan, recorded value for identified intangible assets, or the liability for incurred but not reported claims in the insurance portfolio, including related notes, a schedule of externally managed assets and income of a private pension plan, including related notes, a schedule of net tangible assets, including related notes, a schedule of disbursements in relation to lease property, including related explanatory notes, a schedule of profit participation of the employees' bonuses, including explanatory. So the financial statements or single financial statements that is prepared under SA 805 could either be a general purpose framework or as per the general purpose framework or a special purpose framework. But if in case it is prepared under special purpose framework, then all the requirements of SA 800 would also apply to SA 805. So the first objective would be the engagement acceptance. The key considerations would be the application of SA, acceptability of the financial reporting framework, and the form of opinion. So, for the application of standards on auditing, first would be to whether the independence requirements are complied with. So, needless to say, in every engagement, the auditor has to check whether the independence requirements are met with. It is no assignment is exempted from checking the independence requirement. It's just that I've emphasized on this slide. But checking independence requirement is mandatory for all the engagements that the or chartered accountant undertakes. And whether the auditor is engaged to audit the complete set of financial information. So, one of the important factors in SA 805 is whether the auditor is engaged to audit the complete set of financial. So, in case when we are when a person is when a chartered accountant is appointed to audit the entire set of financial statements, the person would have an understanding of the entire business because have multiple discussions with the management to understand the business of the entity, understand the controls that are relevant in the company, uh, perform testing of the internal controls, identify deficiencies. Then we design the audit procedures according to the results that are obtained from those tests. So our audit procedures are designed according to understanding of the entity based on a discussion, and the procedures that we perform are based on the understanding that we obtain through multiple discussions and the audit evidence we obtain. So, in case we are audited only to or report on provide opinion on the single financial statement, this would be very difficult considering the efforts involved. I would not say it is impossible, but it would be very difficult to obtain all the evidences that we would have if in case we were the auditors of the complete financial statement. Like for example, if we have to if we are engaged to report on only on the trade receivable part, that is, we have to give a comfort to the company about that the trade receivable that is reported is appropriate, including the aging and the confirmation procedures, all has to be done with, and the report has to be given on the trade receivable part. But there is this issue in the company. Suppose there is a going concern issue in the company, which the main auditor, that is the audit of the complete financial statements, have identified after checking the cash flow of the company or the discussion with the management, and it has analyzed the minutes of the meetings, and they have come to know that there is a going concern issue in the company. But this fact would not be known or available to the auditor of the single financial statement, who is appointed only for reporting on the trade receivable part. So this would lead to restrictions, and the audit procedures performed would be restricted, and it would lead to incorrect reporting being done. Further, there will be a situation where there might be a possible chance of a fraud in the company, and the auditor of the financial statements, the complete financial statements, might have identified that after reading the minutes or after performing during the course of the audit and audit evidence obtained, he or she might have identified there is a potential fraud that has happened in the company. This has the auditor has identified this only because of the information that he has obtained during the course of audit, and this would not be available to the auditor of the single financial statement. Hence, while accepting the engagement, the auditor should evaluate whether framework. So we am I audible? I just hello, am I audible?
Yes, ma'am. Yes, ma'am. Yes, ma'am.
Okay, thank you. Yeah. So next would be the acceptability of the financial reporting framework. We need to consider whether there is any restriction that is imposed by the standard setting organization. Like standard setting organizations, like in case ICI, whether ICI has imposed any restrictions on reporting under any financial reporting framework, or if suppose a standard requires a complete disclosure and it states that the entire disclosure has to be made if reported under this standard. If that standard is applicable and if we restrict the information or disclosures to a particular point, then that would be incorrect and that would be a non-compliance of the standard. So one of the criteria would be for the acceptability of the financial reporting framework would be the restrictions imposed. Other would be with the application of the financial reporting framework in the presentation that provides adequate disclosure to enable the intended user to understand the information. So the financial statement should adequately explain what is the financial reporting framework that is used, how it is used, and why it is required. The detailed description of the framework should be given in the financial statement, and auditors should also draw an attention to that fact in the auditor's report. Third would be the effects of the material transactions and events on the information conveyed in the SFS and EFS. So if in case there is any material transaction that has happened or any event has that has occurred in the company, and the auditor needs to draw an attention of the users to such a event or happening. So the auditor has to consider whether there is any restriction imposed by the framework to draw an attention to such a fact. Third would be a form of opinion. So in the acceptance stage itself, the auditor has to agree with the company the form of opinion that would be issued. So whether the form and content of the report of the opinion would be appropriate. It can either be a fair presentation framework or a compliance framework. It has to be agreed at the initial level itself. Suppose in case it's a fair presentation framework, then the words that is present fairly in all material respects, those words can be used. And if in case it is a compliance framework, then it can be used as it's prepared in all material respects. Regarding the usage of the words in the auditor's report, in the opinion paragraph, basically, the presence fairly in material respects and true and fairly. These are the words that we use in the auditor's opinion. So before using such terms, we need to consider whether the law and regulation under which the report is prepared, whether there are any restrictions on using these words, and whether complete disclosure is given as per the applicable reporting financial framework. If complete disclosure is not given, then we cannot use these words, because stating that it presents fairly in all material respects would be an incorrect term. So auditor has to determine at the engagement level itself whether these words should be used. And if in case the objective of the financial statement is to achieve fair presentation, then it is recommended that all the disclosures which are required, all the disclosures should be made which is required more than the prescribed law. So it is always better to exactly describe all the facts that are happening in the company rather than just restricting the disclosures to a particular requirement. Since the user should be made aware of the facts that have been happening in the company. Next would be planning and performing an audit under SA 805. The key consideration would be here to obtain understanding whether the standards relevant to the audit has been complied with. As we have seen in the SA 800 as well, whether all the standards relevant to the audit has been complied has to be kept in consideration for the audit during the audit procedures. Some critical things that to be paid attention to would be careful consideration of relevance of each standard is necessary. Suppose in case we are auditors of the complete financial statement as well as the single financial statement. In that case, most of the times we might have already obtained information or audit evidence in case of while auditing the complete financial statement. So the auditor might use the same audit evidence even in case of the single financial statement, but the auditor has to consider the appropriateness and sufficiency of reporting that audit evidence that is to be considered for single financial statement, because the materiality would differ and auditor needs to consider whether it's sufficient and appropriate enough to report on the single financial statement. even in case of single element financial statements and reporting on the single financial statements, uh, there would be an interrelated items like if we audit up the complete financial statement and then we are engaged to report on the trade receivables, we might already have obtained all the audit evidence during our course of audit during the complete financial statements regarding trade receivables. We might have circulated the external confirmations, obtained the confirmations, perform audit procedures of the aging of the trade receivables. So the auditor can use those evidence in while reporting on the EFS as well. But again, the auditor needs to assess the sufficiency and appropriateness of the auditor. In most of the scenarios, the materiality of the SFS would be less than the materiality of the complete financial statement because we are reporting on the single element or single financial statement. And in such scenarios, the auditor needs to evaluate the nature, timing, and extent of the audit procedures that has to be applied. Because if in case we identify a misstatement and it is if we consider the overall materiality that has been considered in the complete financial statement and we ignore that or we do not pay much attention to those misstatement which is below the materiality level of the complete financial statement, then it would be an incorrect picture because the materiality of SFS is much lower. Coming to forming an opinion and reporting considerations under SA 805. Even in case of SA 805, we need to apply the requirements of SA 700 revised. Suppose in case we are the auditor is appointed for reporting on both the complete financial statement as well as EFS or SFS, then the auditor has to make sure that a separate audit report is issued for each assignment. That is a separate report for complete financial statement as well as a separate report for SFS. If in case the entity publishes SFS along with the complete financial statement, in that case, the auditor should ensure that a proper differentiation is made between the complete financial statement and a SFS that is a single financial statement that is being reported. If there is no proper differentiation, then the auditor should discuss with the management and ensure that the same is rectified. And even in case of the opinion that is issued, there should be a different opinion and it should not be combined, and there should be a proper differentiation between both the opinions that is issued. The auditor should not issue the opinion unless and until he is satisfied that such a differentiation is achieved. There might be a scenario wherein the main report, that is the audit report on the complete financial statement, is a qualified one, or there's an emphasis of matter in the report or other matter reported in the complete financial statement. So what does the auditor need to do in such a scenario? First of all, the auditor has to determine the effect of the same on the single financial statement. Then the auditor has to evaluate whether the same has a effect and accordingly modify the SFS and include the modified opinion on the SFS or EF. Suppose in case there is an adverse opinion or disclaimer of opinion on the complete financial statement. In such scenarios, the auditor cannot issue the adverse opinion, or actually the adverse opinion and disclaimer opinion can be considered separately for single financial statements and element financial statements. In case of single financial statement, if in case there is adverse opinion or disclaimer of opinion on the complete financial statement, in no case the report on single financial statement can be a clean one. That is, it cannot be an unmodified one. It has necessarily to be the basis of adverse opinion and disclaimer of opinion has to be issued in the report on single financial statement as well. That's because suppose in case we are giving an adverse opinion on the entire complete financial statement, that is balance sheet, P&L, and cash flow statement, and then in case of reporting on the single financial statement, suppose we are reporting only on the balance sheet under the single financial statement, it would be incorrect to say that the entire financial statement is adverse opinion, but an unmodified opinion is issued in case of balance sheet. That would contradict the opinion that we are providing. So, in case adverse opinion or disclaimer of opinion is provided in the complete financial statement, then the auditor has to reiterate that fact in the opinion in the report of the single financial statement and describe the basis for such an opinion. However, in case of an element financial statement, if in case the complete financial statement contains adverse opinion or a disclaimer of opinion, and there might be a scenario, there can be a scenario where the report on the single element can be a unmodified one, but there are certain conditions for that. It should not. Second thing would be, suppose in case we are reporting on the cash and bank balance. The cash and bank balance should not form a major part of the complete financial statement. Only in that case we can give an unmodified opinion on the single financial on the element financial statement. Also, another important point to consider in such a scenario is the auditor's report on the element financial statement should not be published along with the audit report on the complete financial statement. Suppose it is published together, then the auditor has to ensure that a modified opinion is also issued on the element financial statement. So these were the requirements of SA 805. Going ahead with the SA 810, engagements to report on summary financial statement. Before we begin with SA 810, what is exactly summary financial statement? So, in case of financial statements, so as per the Companies Act and as per the applicable reporting framework, financial statements comprise of the balance sheet, statement of profit and loss, cash flow, statement of changes in equity, and accounting explanation, accounting policies, and explanatory notes. But this information runs into loads and loads of pages, and it's because suppose in case the company is following the Indian accounting standards, that's India, the disclosure requirements are vast, and it's the user will get confused and because of the vast information that is included in the financial statement. So there might be a scenario where a person would want to get just an overall understanding and would not want the in-depth analysis or in-depth information or disclosure requirement. In such a case, the user might require the auditor to report on the summary financial statement, or in a condensed form of financial statements. So the summary financial statements contains less information, less disclosures as compared to the complete financial statement. Going forward with the definition, as per SA 800. Statements that is derived from financial statements, but that contains less details than the financial statements, while still providing a structured representation consistent with that provided by the financial statement of the entity's economic resources or obligations at a point in time, or the changes therein over a period of time. Different jurisdictions may use different terminologies to describe the historical financial information. So what is covered in SA 810? That is the scope. It deals with the auditor's responsibilities when undertaking the engagement to report on the summary financial statements derived from the FS audited in accordance with the SA by the same auditor. We look in detail about the term by the same auditor in the next slide. Objectives. The auditor's objective would be to determine the appropriateness of accepting the engagement to report on the SFS, form an opinion on the SFS based on the evaluations or conclusions drawn from evidence obtained, and express an opinion through written report that also describes the basis of that opinion. So in SA 810 slides, I've used the term SFS to describe the summary financial statement. So in 805, SFS was used to describe the single financial statement, And in case of SA 810, I've used the term SFS to describe the summary financial statement. First would be the engagement acceptance. Certain criteria that has to be considered for engagement acceptance. First is acceptability of the criteria. The criteria which is used to prepare the financial statement. First, the auditor has to consider whether the aggregated nature of the SFS, including limited disclosure, would lead to a greater risk. So, as I described earlier, the more the disclosure, the better it is, because uh, giving all the information about the company would enable the users to know the exact facts, so that they are not hiding anything, and the company is also not hiding anything, and the user is aware of what the decision they have to take and the intended use. So auditor has to consider whether, due to the limited disclosure of the summary financial statement, would there be any risk involved. If the risk involved is higher, or if there is any risk involved at all, then the auditor should consider the effects on the engagement acceptance. Next would be there certain factors on the for the acceptability of the criteria. First would be nature of entity. Like suppose in case of listed entity, or in case of banks or insurance companies, or in case of a company listed outside India, basically PIEs, the public interest entities, uh, they they are the companies where the rules are very stringent and the public money is involved, and the auditor has to specifically state this, look into the fact that the disclosure would not lead to a misleading information, and the auditor requirements are met with. So the nature of entity has to be considered. Next would be the purpose and the intended use. So if suppose in case the user wants to know where the company has the investments of the company, where the company has invested its money, and just by giving the face of the balance sheet, reporting on the face of the balance sheet would not meet the requirements of the user. So if in case the detailed disclosure of the investment is not provided to the user, then it would not meet the requirements of the particular person. So the information needs of the intended user should be taken care of, and whether the applied criteria will be misleading. That's explained earlier. Generally, the standards that are laid by the standard setting board or the law and regulation is presumed to be the applied criteria, like suppose Ind AS or accounting standards or IFRS, they are generally considered to be the applied criteria. But suppose in case the applied criteria does not exist, then the management might develop the criteria based on the industry practice. However, there are certain conditions that the management has to look into before considering this, and the auditor has to also to give due consideration to such scenarios. One would be adequately disclose the summarized nature and identify the audited FS. Uh, the auditor has to adequately disclose the summarized nature and identify. So the applicable financial reporting framework and the applied criteria has to be in detail explained in the financial statement as well as in the uh, auditor FS and the report that is being issued by the auditor. Second would be clearly describe from whom or where the audited FS are available, or if law and regulation provides that auditor FS need not be made available to the intended user, then state the specific law and regulation which prohibits that. Then adequately disclose the applied criteria, agree with or it can be recalculated from the related information in the audited FS, and in view of the purpose of SFS, contain the information necessary and are at appropriate level of aggregation so as not to be misleading. Suppose uh, in case of summarized financial information, the company just clubs all the information that are all the subheadings under the current assets into a but single head known as current assets. So this would not give the all the information that is required, because the level of aggregation should be taken care of. It should not be too much aggregated that the information that is provided to the user would be misleading. Um, Second would be for the second rationale for engagement acceptance would be management acknowledgement. So management has to acknowledge the aggregated nature of the SFS, including disclosures. They have to acknowledge the responsibility for the preparation of the SFS in accordance with applied criteria. The management must also acknowledge that the audited financial statements are available to the intended user without undue difficulties. Or if the law and regulation provides that the audited FS need not be made available to the intended user of the SFS, and establish the criteria for the preparation of SFS to describe that law and regulation. So if any law and regulations prohibits the making available the financial statements to the public, then or the intended user, then the specific law and regulation has to be specified. The management has also to include the auditor's report on the SFS in any document that contains the SFS. So in case the management includes the summary financial statement in any document that contains the that contains the summary financial statements, the management should also include the auditor's report on the summary financial statements. So it cannot be a scenario that the management has just provided the summary financial statement. They also have to give it along with the summary report on the summary financial. Third would be there might be certain scenario where the applied criteria is unacceptable. In such scenarios, the auditor should not accept the engagement unless and until it is required or mandatory by the law or regulation. In such scenarios, it would not be appropriate to state that it complies with the standards. Accordingly, the auditor's report has to state that this engagement is not is conducted in accordance with the particular law and requirements of the particular law and regulation, and is not in compliance with the standard. Even in case of while agreeing to the terms of the engagement, even in case of the engagement letter, it should state that these facts, and the auditor should also determine the effect it has on the engagement to audit the FS on which the SFS are derived. So the due consideration has to be given to the audit procedures that are being performed. There was just a second. Generally, in case of SA 810, it is required that the auditor who has audited the complete financial statement is required to report on the summary financial statements as well. If you see the international standards, it is a mandatory requirement. That is, if you are engaged to report on the summary financial statement, you need to compulsorily audit the complete financial statement. However, in India, there is an exception. Suppose in case a company is going under a public offering or an IPO, in that case, the auditor has to report on the previous 3 financial statements, and it is not necessary that the auditor has audited or reported on the previous year's financial statements. There might be a different auditor. But in case of an IPO, you need to report on the previous 3 financial statements. And only in such scenarios, you can accept the auditors can be different. That is, the auditor of the complete financial statements and auditor of the summary financial statements can be different. But generally, both these auditors should be same. The nature of audit procedures that are involved in SA 810. The auditor should consider whether the summary financial statements adequately disclose the summarized nature and identify the audited FS. This was discussed earlier that if it is not accompanied by the audited FS, then it should describe from whom and when where the audited FS would be available. And the management should also establish process where the users can get the access to information. If it is not disclosing it along with the SFS, it is not disclosing it along with the audited FS, then the management has to establish a process to get the as to where the users can get the information. Next would be whether SFS adequately disclose the nature of the applied criteria, whether SFS are prepared in accordance with the applied criteria, whether SFS contains necessary information and appropriately aggregated so as not to be misleading. That is, it should not be aggregated to such an extent that the information would be misleading. Whether the audited FS are available to the intended user without undue difficulty, and whether the related information in the audited FS to determine if the SFS agree or it can be recalculated with the related information. Next would be the form of opinion. So if in case the auditor is on the summary is issuing an unmodified opinion on the summary financial statement, then the auditor can state that SFS are consistent in all material respects with the audited financial statements in accordance with applied criteria, or the SFS are a fair summary on the audited financial statements in accordance with applied criteria. If in case the law and regulation prescribes a different wording, that it is different from the fair summary or the material respects. So if in case there is a different wording that is prescribed, then the auditor has to apply the procedures described in the nature of procedure slide. So all these procedures have to be applied while considering such usage of such wording. Evaluate whether the user might misunderstand the auditor's opinion on SFS. And if in case the auditor believes that there would be a misunderstanding, the auditor should perform additional audit procedures or provide an additional explanation to mitigate that understanding. If in case the auditor still feels that the misunderstanding cannot be mitigated, then the auditor should not accept the engagement unless and until it is required by the law and regulation. In all these above scenarios, that is the law and regulation, if it prescribes a different wording, then the auditor's reports cannot indicate that the engagement was conducted in accordance with the standards in auditing. Next would be the timing and timing of the work and events subsequent to the date of auditor's report. That's the subsequent event. So regarding the date of the summary financial statements, the date cannot be earlier than the date on which the auditor has obtained all the audit evidence for performing the audit procedures, and the management has accepted the responsibility for the SFS, and it cannot be earlier than the date of the audited FS, because the summary financial statements is prepared from the audited financial statements. So the date of the summary financial statements cannot be earlier than the audited financial statements. The auditor need not perform the additional procedures on the events subsequent to the date of the audit report on the complete financial statement. So suppose in case the audit report on the complete financial statements is provided as on 30th May 2020, and the report on the summary financial statement is provided as on 30th June 2020. So the auditor need not perform additional procedures or need not consider the effects of the transactions happening between 1st June 2020 and 1st June to 30th June. But the auditor report has to specifically state that the FS summary financial statements do not reflect the effects of the events that occurred subsequent to the date of the auditor's report on the audited financial statements. However, it can happen that suppose in the case of earlier example, as on 30th May, the auditor has issued the audit report on the complete financial statement. However, later after 30th May, the auditor becomes aware of certain facts which existed as on 30th May, but he was aware of that fact later. Then the auditor cannot issue the auditor's report on the summary financial statement unless and until the main audit report, that is the audit report on the complete financial statement, is revised or it is given due consideration to, and then only it can report on the summary financial statement. Some of the key elements that has to be included in the the report on the summary financial statements. First is the title, that is the auditor can state that report on independence report. So stating the term independent would state that all the independence requirements are complied with. Who is the addressee? It would depend upon the user, in the intended user. So the addressee can be accordingly mentioned. Introductory paragraph should state that I should identify the title of each statement. So that it should identify whether it's the balance sheet, the P&L, or the cash flow. It should identify that there is an audited financial statement. It should refer to the auditor's report on the audited financial statement and the opinion that is drawn on that financial statement. It should, as we discussed earlier regarding the subsequent events, it should state that the auditor has not audited the summary financial statement do not reflect any effects of the events occurred after the report date on the complete financial statement. And it should also state that the summary financial statements do not contain all the disclosures, and reading this financial statements would not be a substitute to reading the complete financial statement. This has to be mandatorily mentioned in the report. Some of the reporting considerations. Suppose in case the main audited financial statements contains a qualified opinion or emphasis of matter or other matter. In that case, if the auditor of the summary financial statement is satisfied that all the requirements are consistent in material respects and provides a fair summary, then the auditor should report on the summary financial statement and draw an attention to the qualified opinion, EOM or OM, describe the entire basis which is stated in the complete report, and evaluate if there is any effect of the same on the summary financial statement and disclose appropriately. Suppose in case there is an adverse opinion or disclaimer of opinion in the complete effect. In that case, the auditor's report on the summary financial statement should state the fact that the main report, that's the audit report on the complete financial statement, contains an adverse opinion, describe the entire basis, and also state the fact that the report on SFS we cannot express an opinion on the summary financial statement because of the adverse or disclaimer opinion on the complete financial statement. In case the main audit report, that is the auditor's report on the audited financial statement, is the unmodified one, but if the auditor believes that the SFS are not consistent in material respects or does not provide a fair summary of the audited financial statement, and management does not agree to make the necessary changes, then the auditor can issue a qualified opinion or a modified opinion as the case may be. A mandatory requirement that is in SA 810 is the restriction on use and distribution para. As we discussed earlier as well in SA 800 and 805, it should alert the users that the financial statements has been prepared, the summary financial statements has been prepared on a special purpose framework. What is the purpose? Who is the intended user? And it should also state that it will not be suitable for any other use. Coming to comparatives. Comparatives, that is the financial information of the previous period that is included in the financial statement. If in case, generally in the general purpose financial statement, the audit, suppose if in case of the financial statement for the year ended 31st March 2020, the financial statements would also contain the information of the financial statement for the year ended 31st March 19. But in case of summary financial information, the management might choose or the entity might choose not to report on the not to present this comparative information if in case information is useful to the user. Next would be the unaudited supplementary information. Hello?
Continue.
Yeah. Next would be the unaudited supplementary information. So in such a case, the auditor has to evaluate whether the audited information is clearly differentiated, and if it is not differentiated, then the auditor has to clearly ask the management to differentiate it. And second would be the other information that is included in the documents. So if in case other information is included, then the auditor has to read all the information, and if there is any material inconsistency, it has to be discussed and evaluated whether the summary financial statement or the other information requires revision. If it requires revision, then accordingly audit procedures have to be done. The last would be auditors association. If the auditor becomes aware that the entity plans to state that auditor has reported on the summary financial statements in a document containing SFS, but does not plan to include the related auditor's report, the auditor shall request the management to include the auditor's report. in this document. However, if the management does not agree, then the auditor shall determine and carry out appropriate actions to prevent the management from doing so. It would include any legal procedures that has to be undertaken by the auditor. Just next is the report formats. These are just the illustrations. This all these requirements are covered in each and every standard. So it's just the report, the illustrative formats that have been mentioned in the standard. SA 800, like it has to be reported the management responsibility, auditor's responsibility, opinion, and the basis of the accounting and distribution. So it has to be mandatorily stated that it is to be used only for, it cannot be used for any other purpose. Similar is the case of 805. We have discussed in detail about each and every requirement. Not going through the entire detail. Yeah, that's it. This was from my side. Any further questions on this? Hello.
Yeah. Vishwa ji, questions लगाइए.
Sir. Can I?
An auditor's report on special purpose financial statement is addressed to whom? That is whether to the board or to the members. Please give examples whether the user for and to. So it can be addressed to either. It depends upon the intended user as to whom the financial statements is intended for. Accordingly, the addressee can be mentioned. 805, that is a single element financial statement or an element financial statement. It can be used in different scenarios, like in case of a bank, if it requires a report on the inventory, then the auditor can use a report on can report on the particular financial element, and it can be the SA 805 requirements can be applied in such a scenario. Second is financial statements prepared in accordance with the special purpose framework may be the only financial statement entity prepares. Those circumstances, those financial statements may be used by the user other than those for whom the financial reporting framework. Despite the broad distribution of the financial statement in those circumstances, the financial statements will be considered as special purpose framework. SA 800 guidance on issue of certificates. So in case of SA 800, we give a reasonable assurance, because reasonable assurance is a case where we state that it's not an absolute assurance, giving due considerations to the inherent limitations of audit. We say that uh, we do not give a complete assurance, but although we do not give a complete assurance, we give a reasonable assurance. That is also that is more than the limited assurance that is we obtain. मुझे फर्स्ट दो क्वेश्चंस दिख रहा है, क्वेश्चन नंबर 3 नंबर दिख रहा है.
क्वेश्चन 3 नहीं दिख रहा मैम आपको?
I can see question 1, question 2. क्वेश्चन 3 सिर्फ नंबर है.
अभी ब्लैंक के देखिए.
Okay, yeah. Could you please give the names of companies that have reported under SA 810, which is available in public domain? I cannot recollect actually any any reports available in the public domain. It is generally given in the specific for specific use, so it is generally not available in public domain. So yeah, it will not be available publicly for everyone since it is used for a public intended user. Fourth question is whether when auditors report on entities, complete financial statement is modified or that report includes an emphasis of matter or another matter paragraph, then auditors report on single financial statement or on a specific element. Yes, it should be given. If the auditor concludes that it is necessary to express an adverse opinion or disclaim an opinion on the entity's financial setup, complete set of financial statement as a whole, but in the context of separate auditor financial statement that is included in those financial statements, the auditor nevertheless considers it appropriate to express an unmodified opinion on that element. When can the auditor do so? If the overall report has a qualification, then the report on the particular financial statement also should have a qualification. Yeah. In that case, a clean report cannot be issued. So if the entire financial statement, audit report on the complete financial statements has a qualification, then this report should also be a qualified one. Sixth question है उसमें. I can just see the question number 6.
No, there is no sixth question. It's just they have numbered it in case there is any.
Okay,
but I think you have very crisply answered all the questions. Yes, there is something that has popped up. Veena, if you could just take it up.
Yeah, sure. Auditor of Y Limited wants report as per SEBI LODR for A Private Limited. As an auditor of A Private Limited, audit report is to be issued under SA 800 and SA 800. Yes, it can be issued under SA 800. I guess according to me, it can be issued under SA. If it is specifically required under SA as per SEBI LODR, or if the format is specified by the SEBI LODR requirements, then the requirements of SEBI LODR also has to be given due consideration. So the requirements of SEBI LODR also has to be taken into consideration.
Yeah, thank you, Veena. You can now switch on your camera. I think.
Yeah.
I would even request Dharmendra ji.
Sorry, I overshoot the time by around 6 to 7 minutes.
No issues. Actually, we had that technical problem, yeah. So it's always. I think you very aptly. Am I on mute? No, I think I'm audible, right? Yeah.
Sir, okay.
Yeah. So very aptly covered the question answers because. Friends, let me tell you that this is the first time that Veena is making a presentation at WRC, and we all know that how difficult, be it on virtual platform or on physical platform, the answering to questions is, and very nicely covered. Thank you, Veena. I would now request Dharmendra ji to kindly propose a formal vote of thanks. Oh, we can't hear you, is it? Okay. Fine. No problems.
धर्मेंद्र सर, आपका माइक म्यूट है. तो ऊपर देखिए रेड कलर का एक एरो है, उसके नीचे माइक ऑप्शन है. नहीं, ऑन नहीं है, ऑफ है. अभी देखिए. हाँ, अभी बोलिए.
Yeah, now it is fine. Now it is fine. So I was trying to unmute myself, but I was not able to. But yeah, that's why. Thank you, Vishalji, for giving me an option to formally thank Veena ji. So Veena ji, on behalf of WIRC, first of all, I will like to thank for such a wonderful session which you have taken, specifically on a very complicated subject. And as Vishalji told, that it was first time for you. So I believe, yeah, considering that it was first time, it was fantastic, and there is a long way to go for you, Veena ji. Congratulations and best of luck for that. And I would just like to summarize or put a gist on what Veena ji told. So Veena ji covered the auditing standards, specifically the categories of standards on auditing, standards on review engagement, standards on assurances, and the related services. And then she specifically covered SA 800, SA 805, and SA 810, which talks about more on special considerations on audit of financial statements prepared in accordance with special purpose framework, or 805, which is audit of single financial statement and their specific element. And then even in terms of the application of the standard, AFRF, its adequate disclosure, effect of material transactions or form of opinion, with true and fair opinion and all. So in 810 also, which is audit of summary financial statement, where she covered all the elements in terms of engagement of report on summary financial statement, applicability of criteria, risk involved, purpose and intended users. And specifically in all these three auditing standards, she has beautifully covered do's and don'ts for auditor, do's and don'ts for management, in line with the prescribed framework by different authorities, and its purpose and intended users. So it was wonderful session, Veena ji, and I believe, and I am very sure that the participants would have been got a lot of insights and knowledge from whatever you shared today. Thanks a lot once again, Veena ji. And now we move to our next session and hand over the baton to CA Prateek Khandelwal ji, who have already joined us. And Prateek Khandelwal ji, just I would like to take a minute to introduce him. He is a director assurance for MSKA and Associates in their Mumbai office. He is having around 9-year vast experience, and his area of expertise is statutory audit, Ind AS, IFRS conversation, and control framework. His industry expertise is BFSI, which covers banking and capital markets, stock exchange, private equity, mutual funds, and all. So he has led so many audits of listed clients in India, and even in some engagement internationally also. He has worked on large financial services clients like banks, non-banking financial corporations, housing finance corporations, equity and commodity broking audit, private equity audits, and he has led capital market transactions including bond issues, QIPs, etc. And he has also actually managed and been part of transition of financial services clients to Ind AS and IFRS. Welcome, Prateek ji, and I will hand over it to you now.
Thank you, sir. Thank you so much. Thank you, Vishal sir, Dharmen sir, Vithal sir, to whom I can see on the screen. Thank you so much, all the coordinators who are there, because in the current pandemic, we are still on, and signifies the purpose that we are a part of a nation building and we are continuously on with our work. So that's very important, being a chartered accountant. Thank you so much to all the attendees, and a very good evening. I just now come on my topic of a discussion, which is SRE 2400-2410, It is the standard on review engagements. And these are the two engagements standard, which defines that when an auditor is engaged for the review work, how the work would be performed and what are the do's and don'ts for an auditor in terms of his guidance to discharge his responsibilities. So let's start this session on SRE 2400 and 2410. So we'll spend our time on the below areas. We'll understand that what is the scope and objective of SRE 2400 and what is scope and objective of SRE 2410. We'll also understand the difference between the review versus audit, where the review is differentiates from the audits. What are the preconditions of a review under 240010, how to perform the engagement, and whatever the evidence is collected, how to evaluate to arrive at the conclusion. Our communication with those charged with governance, which is a two-way communication during the whole engagement, arriving at a conclusion. There are certain other considerations which needs to be mandatorily taken care of, and we'll understand that after going through with all the slides, what are the overall difference between 2410 and 2400. So first I come on SRE 2400. SRE 2400 is engagements to review historical financial statements. And this SRE comes into picture when it has to be reviewed by a practitioner and not by the auditor of that entity. So when you will go with this scope, it clearly says the practitioner's responsibilities when engaged to perform a review, and practitioner is not the auditor of the entity's financial statements. And that's why SRE 2400, going forward, wherever I will use a word, it would be a practitioner and not an auditor, because he is not an auditor of that entity. So this is the scope which clearly defines what is required under SRE 2400 and when this SRE would be applicable. It also defines the form and the content of the practitioner's report on the financial statements. So what would be the practitioner's objective? Okay, when SRE 2400 is applied, the objective is to arrive at a conclusion and draw a conclusion in form of a report that whether anything has come to his attention which causes him or her to believe that financial statements are materially misstated. It's very important to understand. In upcoming slides, we will also understand why such language is drafted in terms of conclusion in the report. So the objective is to arrive at a conclusion whether any material misstatement has come into the knowledge of a practitioner which causes him that financial statements are not prepared in accordance with the applicable regulatory framework and law. When I move to SRE 2410, Standard Review Engagement 2410, it is review of interim financial information performed by the independent auditor of the entity. See the difference. It clearly says the auditor of the entity means a chartered accountant or a firm who is auditor of the entity, and if performed, the review of interim financial information has to follow SRE 2410 in order to plan and perform the audit procedures, arrive at a conclusion, and report accordingly. However, my opinion will go and follow the same direction, that all evidences which is required in the audit has been collected, and whether which causes him to or her to believe that whether financial statements are not prepared in accordance with the applicable regulatory framework. So we need to understand these two basic difference between the application of this SRE 2400 and 2410. There are various processes, various procedures, various matters which are common in both SRE. So in upcoming slides, I will take you through there, and wherever it differentiates, I will highlight those matters specifically, that where 2410 differentiates from 2400. Okay, so first we should understand what is review and what is audit. So there are certain bases given over there on which ground I have classified or differentiated a review and the audit. So first is level of assurance. Since it's an audit, assurance function. In a review, we say it's a limited assurance. When it comes to limited assurance or the negative assurance, we mention that these are whatever the work we have performed, nothing has come to our attention which causes us to believe that whether any material misstatement exists or does not exist. And that's why in my first two slides I said that why such kind of language I will explain you in the next slide. It's a limited assurance or a negative assurance. But when we perform an audit, audit is a reasonable assurance where you are giving a true and fair view opinion on the overall financial statements and perform various extended audit procedures to give an overall reasonable assurance. Procedures to be performed. Since review is a limited assurance, the key procedures are inquiry and analytical review. While when it comes to audit, it is the test of controls, as the case may be, or required, and the test of details. The test of details, the all procedures like we perform the observation, inspection, re-performance, recomputation, confirmation procedures. One example, in review, we generally don't send or seek a third-party confirmation, but in audit, we do. It's a mandatory requirement for certain areas at least. Reporting, it's a review conclusion, while in audit, we issue a true and fair view opinion on the overall financial statement. Standards to follow, in review, SRE 2400 or 2410 as the case may be, but when we do audit, it's the all standards on auditing requirement, all SS that we have to comply with. Control. So there are certain SS which are part of review as well that we have to comply, but primarily it follows from SRE 2400 and 2410 when it comes to review. Control opinion, it's not mandatory in any review. In audit, it is mandatory because section 143 is there, and it asks for an IFC, the internal financial reporting control opinion. So that's why I have mentioned mandatory is applicable because certain private limited companies are exempt out of that. CAM reporting with amendment in SS 701, key audit matters are required to report. In review, the CAM reporting is not required as it is applicable to the complete set of financial statements. And in review, we generally don't prepare the complete set of financial statements for the general purposes. While in audit, we do that. So when we prepare the general purpose financial statements with all disclosures, CAM is mandatory, CAM is applicable. Regulatory requirement. Review. Generally, review is done because of maximum by the listed entities, and they have to follow the SEBI directions, and there is a SEBI listing obligation and disclosure requirement directions in place which ask for the listed entity basis their nature of security listed on exchanges either a quarterly or a half yearly review by the auditor, and that's why the review requirement comes, which is primarily driven by SRE 2410 because SEBI requirement asks for it is to be done by the auditors of the company, and when it has to be done by auditors of the entity, then 2410 comes into picture. While when it comes to audit, the regulatory comes from primarily from the Companies Act, because all the relevant act or the statutory requirement, there are certain specific companies like insurance company, banking companies, electricity companies. There are their own act, and from there the requirement flows. So these are the broader difference between the review and the audit. Now, we come to the preconditions on the review when we start. The first and foremost and non-negotiable and the mandatory for an auditor or a professional accountant is ethical requirements. Integrity, objectivity, confidentiality related to the client data and information, our competency, professional behavior, everything. And that should be the and the primary requirement that a professional accountant should qualify when it comes to 2400 or an auditor when it comes to 2410. Moving ahead, professional skepticism and professional judgment. What is professional skepticism? Professional skepticism is, so what is expected from us? We are expert of auditing and accounting, and our opinion gives a sense of relief to the users of the financial information that the financial informations are true and fair. And accordingly, it is expected from us that while evaluating and auditing or reviewing those financial informations, we apply our professional skepticism to very well evaluate the evidences that we have obtained during the course. So like questioning mind, when you find any evidences which is contrary, any unusual circumstances, inappropriate evidences, or any matter which comes to the auditor's knowledge that it is of high importance and should be looked in a different way. So this is the professional skepticism. Professional judgment. Professional judgment is, so when we issue our opinion, it's my opinion, it's our opinion, and basis our assessment of the evidences that we have obtained. In preparing the financial information, management takes various kind of judgment and estimates from their side. And as an auditor, when we perform our procedure, in terms of 2400, it's a practitioner, 2410, it's an auditor. Very well required is that we follow our judgment very accurately and appropriately, and the basis of taking those judgments should be well documented. So what are the areas of judgment that we take? Materiality, nature, timing, and extent of audit procedures we have to perform. Whatever the judgments which have been taken or considered by the management, we have to consider. And forming the conclusion, if we have identified any material misstatement, how it should be appropriately reflect in my conclusion or in my opinion. It's very important. Next is engagement quality control. Of course, our competency, appropriate procedures, compliance with the laws and the regulations, professional standards, pronouncements issued by ICAI and other regulators. It's very important, and we ensure that our work is done on all the grounds and quality is ensured. And let me put here one more statement. These are not only the preconditions for SRE 2400 2410, but being a professional accountant, it's well expected from us that we are fully compliant with all these preconditions, basic requirement on any engagement we perform. Acceptance and continuance. What is acceptance and continuance? Before onboarding on any client, it's very important to understand and to have an answer of various questions on the ground of management, their business, and auditors, both the sides. And basis that to arrive at a conclusion whether to accept engagement or to continue with the existing engagement. So what are those questions? What is the scope of the engagement? What are the rationales? Are we compromising with any ethical requirement? What is the business of the company or the entity? What is the management structure, whether it is simpler or complicated? Whether it is of well reputance or there are various concerns engaged to the entities? Whether any limitation on scope of work is being put by the management or the board of the directors or their governing body? What are the applicable financial reporting framework at the same time to assess our competency to perform and deliver what is expected out of it? Kind of various questions. And if there is a satisfactory reply, we should accept or continue the engagement as the case may be. I want to add one more thing here, that ANC is the process. Acceptance and continuance is the process where we assess the risk attached to the engagement and the client. So it's a very important tool an auditor should or the reviewer should follow before getting into. Agreeing the terms of the engagement. Again, this is the standard on auditing's requirement, and it's very important for an auditor before starting the engagement. The term needs to be agreed, which generally includes the scope of services, management responsibility, auditor's responsibility, termination clause, applicable regulatory framework, fee clause, confidentiality clause, or any other clause as auditor and auditee finds to be, and needs to be agreed upon that before the start of the engagement. Now, so what we have understood till time is what is SRE 2400-2410, what are the preconditions before getting into the engagement. Assume that we have completed all activities and now we have onboarded what work we have to perform and how we have to plan. The first thing comes into picture, the materiality. Materiality in the judgment of the auditor and basis the nature of the client and the nature of the industry, auditor should assess. Since materiality is itself another topic, but I will just pick up a very critical aspect of it. Basis the nature of entity and on what factors an entity will be assessed should be considered as a benchmark for determining the materiality. If an entity will be assessed basis their profit before tax, that should be the element. If entity is assessed basis their asset side, that should be considered. So these are, if entity is assessed basis the overall revenue they generate from their business, that could be one of the benchmark to determine the materiality. So in the review engagements, materiality determination is first and foremost requirement, because when we issue an opinion, is it true and fair, and we have to always identify if there is any material misstatement, because we generally do the risk-based audits. So if there are no material misstatement, there could be a misstatement, but not material to the financial statement as a whole, is within the risk acceptance level of an auditor. So materiality should be well defined, and it is completely on the judgment of an auditor. The next point I move, understanding of entity and its environment. It's a very, very important aspect, and it is another key element to identify the risk attached to the review engagement. And I will put more time and some focus on this particular aspect. So understanding of entity and its review engagement. When you do audit an entity, you are supposed to issue an opinion, and when you do review, your review conclusion. So it's very important that you understand the entity from its business perspective and the industry in which that entity operates. I just put some examples over here. One entity and its industry example over here. There is a bank, XYZ Bank Limited, and of course, since it's a bank, the industry, it's a banking industry, the banking company. And as a bank, they need to follow RBI directions and regulations because RBI is their prime regulator, and other regulations as the case may be or applicable to them. There, if I want to assess the XYZ Bank Limited, so there are two situations before moving ahead and that we need to understand. See how 2400 and 2410 will behave differently over here. When it comes to 2400, as I told, the professional accountant or the practitioner who is not an auditor of the entity. And when it comes to 2410, he is the auditor of the entity, assuming he is the continuing auditor of the entity. So when it comes to practitioner who is not the auditor of the entity, his responsibility increases more on the ground of understanding the entity and its environment. So in my example, if that practitioner is reviewing the XYZ Bank Limited engagement and is not the auditor, he should understand the banking and the industry where this banking operates. He must have the knowledge of the banking regulations, RBI regulations. He must understand the nature of the transactions, how accounting differentiate from the generally accepted accounting principles because there is a specific regulator comes into picture. From understanding of entity perspective, various factors comes into picture. The knowledge of relevant industry, regulator, external factor that is affecting to this, as I just said. And how can we get into much on the understanding the entity? Reading of their latest annual report if available or latest financial statements, discussing or having an inquiry with the top management and the middle management in the organization who has more idea and experience of working with that organization, reading the policy and other frameworks that is available with him, which will give an overall idea of that particular entity. At the same time, a practitioner or an auditor, as the case may be, should also understand the financial applicable reporting framework, selection and application of the correct accounting policies, how's the entity's funding structure is there, what is the organizational structure is there, who is on the top management, what is their profile, how they operate, their business performance over a period of a time. Because all those factors will give enough base and a foundation to a practitioner or an auditor to draw its audit procedure and assess the risk attached to this data. So if I'm an auditor of XYZ Bank Limited, I'm reviewing for the half year ended September 2020, what would be my prime focus? From understanding perspective, if I know the bank and I know the current scenarios which is going on because of COVID-19, the banking industries are in serious pressure. There are certain matters going on related to the banking industry. You must know interest on interest matter, NPA matter, which is in the Supreme Court. And without having knowledge of those factors, if we perform review engagement, it will fall back on us because it is not application of correct professional skepticism as well as the lack of understanding of the industry and its environment. And that's why this factor comes into picture, and it's very important to have a knowledge of entity and its environment. And basis that knowledge, if a practitioner or the auditor find any risk, then those risks needs to be assessed for discharging the auditor's responsibility in terms of completing the review engagement. So that's very important and key for a practitioner or a reviewer as the case may be. So what we have understand the planning of an engagement. Now we move towards the designing and performing the procedures basis the information we have obtained, the knowledge we have gathered, and the overall assessment we have made for an entity. So What kind of procedures we need to design and how we have to perform. It's very important. So when auditor is a risk defined for an engagement, designing and performing the procedures should be in a way that those risks could be avoided and the material misstatement could be avoided. So as I just mentioned, it is to address all material items in the financial statement. Why material? Because we always give true and fair opinion, and that's why materiality comes into picture. And to focus on addressing areas in the financial statements which is not materially misstated, because in case it is materially misstated, it could impact the opinion. We will go now in a detail, and from here, the significant, or I would say the most important requirement of review engagement starts, which differentiate the review engagement from audit engagement. As we mentioned in our earlier slide, that the review is primarily inquiry-driven procedures and analytical review-driven procedures. Okay, so what is inquiry procedures? Again, I want to differentiate here 2400 and 2410. In 2400, if a practitioner is getting on board and performing any review engagement when he is not an auditor, the scope of the question and the band of the question should be broader because he or she has to emphasize more on certain aspects where he or she is not aware. But when it comes to 2410 and auditors of the entity, especially when he or she is the existing auditor, they have the basis and the foundation, and they just want only an update by way of those inquiry procedures. So that's a difference comes in terms of applicability of 2410 and 2400. So inquiry procedure is the first key procedure. Now, inquiry with whom? Business heads, functions heads like compliance, secretarial, and legal, finance head, finance controller or the chief financial officer, HR head, credit head. Credit when you are reviewing any lending institution engagement, and the credit is the team who decides whether a loan will be given to a particular customer or not. So that's the credit who manages the from the credit perspective. So the credit, it's an inclusive list. It could be very exhaustive. It all depends on the nature of industry and the client with whom you want to make the inquiry procedures. So it all depends where you work and the level of person and what kind of information you are looking after. Okay, now moving ahead. What kind of inquiry you need to make? So with whom we understood. Now what kind of inquiry? The level of inquiry and what could be the question of inquiry is totally basis the professional judgment of an auditor. But there are some generic guidance and generic questions, and pursuant to SRE 2410 or 2400 needs to be into the practitioner or auditor's agenda. So what? Update of overall business for the period under review. So you should obtain an understanding that what was the overall business performance of the company or the entity. Obtaining an understanding of whether any new significant contract or agreement entered into by the company or entity, because that will give a knowledge of any further financial transactions if company or entity undertakes, or modification in any existing contract or the agreement which could have impact on the financial statements or the accounting related areas. update on the regulatory matters, laws, and regulations. Certain industries are highly regulated, as I just said, banking, insurance. Banking, in addition to the company sector, RBI is the prime regulator. In insurance, IRD is the prime regulator. And all time, just to govern and regulate these industries, they issue various circulars, laws, and regulations. So the question comes to take update on those circulars, laws, regulations, their implementation status with our view. When I use the word regulatory matters, it means if any inspection is going on, if any matter which is a company or entity is dealing with a regulator or any adverse communication from any regulator, those questions and aspects should come in your inquiry procedures. Update on changing controls, processes, new products, business, just to understand what changes have been made by the entity when we last reviewed and currently we are reviewing. So as I said that again I will differentiate 2400 and 2410 in terms of applicability, or shall I say the scope of applicability. In terms of 2400, when you are the first time reviewing any entity as a practitioner, your responsibility increases and you should inquire more on this because you are getting the knowledge of that entity. But when it comes to 2410, and if it's an existing auditor, the knowledge of the base is in place, so the level of inquiries does not get into that detail. Understanding and update of any change in the accounting estimates or change in the accounting policy, like because those accounting estimate changes or accounting policy changes could have impact on your financial statements or the financial information. Any fraudulent matter noted by the entity, either by the employee of the entity or by a third party on the entity. So from your understanding and update perspective, it's very important. Any subsequent event after the date of your reporting and up to the date of your issuance of opinion, any matter which could have an impact and require adjustment or disclosure as per the subsequent event standards, as the case may be. Update and understanding on those parts. Related parties, any new identified related party or change in the existing related party structure, any new kind of significant contract entered into with the related party, and assessment of the arm's length price kind of inquiries. Any industry specific matter, again I come back to my example. I'm doing a review of XYZ Bank Limited, and I want to discuss the matters more related to the moratorium, Supreme Court matter, RBI directions, application of the RBI circulars. So those industry specific matters. Any other matter as per practitioner risk assessment by applying risk assessment tools. The risk assessment tools just we discussed. From ANC, if you come to know on NEVs, from understanding of the entity and its environment, you arrive at on NEVs. Any other matter. So this is a kind of a list of examples. But any other matter, as a practitioner or a reviewer, you believe that you must have an idea and the knowledge and the complete update. Please incorporate in your agenda item and discuss this with the management. Always a good practice, you have a proper agenda circulated, given a time to the management, and have a detailed discussion on those agenda item. Could have a very well structured discussion and the various kind of inputs for you to perform the review engagement. So we have gone through with the first and the foremost key element of inquiry procedures that we need to perform while performing the review engagements. Now, moving ahead, the second most important process or the audit procedure is the analytical review. So like we discussed in our earlier slide that review is different from audit. and the level of procedure and the extensive procedures we perform in audit, we don't perform in review job. So that's why here we perform analytical review. What kind of analytical review could be there? Again, it is a complete professional judgment of an auditor, which and what form and shape of analytical review to be performed. This is the knowledge of the entity and the industry to obtain the sufficient and appropriate audit evidences which can support the audit opinion that he will be issuing. I just take few examples. Again, I go with my same example, XYZ Bank Limited. I'm reviewing for the half year ended September 2020. I will make certain analysis. I will compare the loan disbursed by the bank in first 6 months of the current financial year under review with the corresponding 6 months of the previous year financial statements. I could have a review on the advances or the deposit base of that bank with the corresponding previous year period. Now, I want to link here 3 things: understanding of the entity, analytical review, and inquiry procedures, and how these work together. Since I am aware of the entity, I have a knowledge. I am aware of the industry, the environment in which it operates. I know what is happening in the banking industry as of now. We have been passed through a lockdown situation in the moratorium in the country. Management has told us in one of the inquiry procedure, one of the business head, the disbursements were not of very up to the mark, and compared to previous year, approx 50 to 60% reduction in the disbursement. When I compare the numbers, if my current half year ended disbursement amount comes to 400 crore compared to the previous year 1000 crore number, we justify the statement that there is a reduction of a 60% in the disbursement compared to previous half year ended, a corresponding previous year financial information. So that's how we corroborate the information that we have got during inquiry procedures with the financial numbers or other information that we get. So this is one of the analytical review, means comparing the periods. Another analytical review, comparing the current period actual number versus current period budgeted numbers approved by the governing body or the board of directors, and just to make sure that whether those numbers are in line or not. Various industries are assessed basis their various kind of ratios. Again, I come to my example, XYZ Bank Limited. A bank is always assessed basis their GNPA ratio, net NPA ratio. These are very technical jargon words. I hope most of you are aware. A non-performing assets ratios, okay, net interest margin ratios, return on asset or the return on equity ratios, and the trend analysis and the ratio analysis around that ratios, that how those numbers are working. Comparison of entity specific ratios with the industry specific numbers, which will give more evidence to a practitioner or a reviewer to assess that whether entity follows the industry trend or not. There are various kind of trend analysis can be done. Statistical tools can be applied like correlation, regression, deviation analysis. So analytical review procedure is completely as per the application of professional judgment of a practitioner or the reviewer in the form and the shape the information could be looked upon. So what I have told you is kind of a few examples, but those all will more relevant when you understand the risk better and then you draw your audit procedures accordingly. There are certain other procedures we perform in a review engagements. review of the minutes of the meeting. It's very important because those minutes of the various meetings, the board of directors, audit committee, and other committee meetings gives insights of various discussions and what is happening in the entity. Review of significant contract agreement transactions. We discussed in our previous slide in terms of taking the update from the management as and when we should also review the same. And the last is very generic and the open point, like in terms of procedures performed by an auditor, if he further believes that in terms of his professional judgment, he wants to extend the audit procedure, or if he want to perform any other specific audit procedures to obtain more sufficient and appropriate audit evidences, an auditor can, a reviewer or a practitioner can apply. But at the same time, it should be clear that it's a review engagement, it's a limited assurance, and the procedure should be done accordingly. Now, evaluation of evidences for conclusion. So whatever evidences we have obtained, inquiry procedures are made, okay, whether they corroborate to each other or not. As per audit procedures performed, have we identified any usual or unexpected item? How we are dealing with this unusual or unexpected item, like we find any significant deviation, like we find any agreement which is not as per the applicable accounting framework, like we find any accounting policy which is not as per the accounting standard or the relevant laws or the regulations. Those items should be identified, and a practitioner or a reviewer should evaluate if these items have any impact on the report. Whether the financial statement or the financial information obtained from the client tie back with the trial balance in the general ledger, it is again one of the mandatory procedure that has to be performed. Use of work of expert. If management has considered a work of expert and it goes in terms of the accounting entries and the judgments, an auditor should apply, or the review practitioner should apply all audit procedures to ensure that those judgments and expert is competent and output given in the financial information is correct. A going concern assessment needs to be performed. This is the inquiry procedure, this is the financial health of the entity, and this is the other evidences obtained. Subsequent event assessment, if any, we just discussed that matter. Now, communication with those charged with governance. It's very important. There is a separate standard on auditing given that at which level, at what stage, those communications should be established, and a proper two-way dialogue should always remain open. See, it's very important. When we do a review or an audit in a generic sense, we discuss with the management, and there is always an independent body or a governing body who obtains comfort from the practitioner or the reviewer, or in whatever capacity we work, to ensure that the financial information given in the financial records of the entity are true and fair, and there are no material misstatement exist. And that's how it increases our responsibility to put our communication very clear with those charged with governance. So what are the significant areas where we should always keep our dialogue open? Those charged with governance could be the audit committee, where the independent director sits, and those audit committees are very well regulated. The board of directors, generally, who forms the TCWG members. When a management puts a limitation of scope of work on an auditor is unable to perform the overall audit procedures, it's very important for him to highlight this matter to those charged with governance. Any significant matter or a finding to review, if it comes into the attention of the auditor, it's very important to approach to those charged with governance and highlight them. It's a two-way communication, as I said. If after application of all the procedures, a reviewer or a practitioner reaches to a conclusion that an opinion would be a modified opinion, We'll discuss this modified opinion in in the upcoming slides. But if it is a modified opinion or an emphasis of matter para is required, those matters must be communicated to those charged with governance. There are the separate SS, SA 701, 705, 706 as the case may be, and those standards requirement also comes. SRE also goes on the same line. Significant difficulties if practitioner or reviewer does not getting the full cooperation from the management, any limitation on the scope of the work, or any matter which in his mind gives a threats or the bearing that he is unable to perform a complete audit procedures to obtain the sufficient appropriate audit evidences, those all matters should be immediately communicated to the charged with governance. I just want to highlight one point over here. If practitioner or reviewer approach and communicate those matters and does not get the satisfactory response to discharge their responsibility, they should assess the resigning from the work within the applicable framework of laws and the regulations which governs that industry and as per the professional standards as well. Now, from a conclusion, so what we discussed till time, how to plan the engagement, a review engagement, what kind of procedures we need to perform, what kind of judgments could be there, the risk assessment tools, how to evaluate those evidences. And now, to arrive at the final conclusion and to form an opinion. As per standards on auditing, an auditor could have two opinions, unmodified opinion and a modified or a modified opinion. Unmodified opinion, which is a true and a fair opinion, where auditor, reviewer or the practitioner confirms that the sufficient appropriate audit evidences are taken, no material misstatement exists, and no matter is noted which could have resulted into a material misstatement. An unmodified opinion will be issued. When it comes to modified opinion, a modified opinion goes further down in three opinions: a qualified opinion, adverse opinion, and a disclaimer of opinion. In my previous session, Veena has also covered these opinion discussions. So I'll just take a little bit on that. When it comes to a qualified opinion, what is qualified opinion? When you find a particular area where the material misstatement exists, material misstatement due to because of not as per applicable generally acceptable accounting principle, not as per applicable law or regulation, or something which is not correct and needs the attention of the users of the financial statements, but it is not pervasive to the financial statement as a whole, then it's a qualified opinion. And in the qualified opinion, a reviewer or the practitioner should mention, except to this item, the financial information gives true and fair view opinion. Adverse opinion, when a material misstatement is identified and it is a pervasive impact to the financial statement as a whole, which is more grave than the qualified opinion, the adverse opinion comes into picture where the true and the fair view is questioned. A disclaimer of opinion, when auditor finds that sufficient and appropriate audit evidences are not available, there is a limitation on the scope of the work, or he is unable to perform his complete work, and opinion has to be issued, a disclaimer of opinion will be issued. The last is emphasis of matter para. Emphasis of matter para, we shortly call EOM, is not a modified opinion. However, there are certain matters which requires or needs a specific attention of the users of the financial statement. An auditor needs to put emphasis on that. Those kind of matters will be reported under EOM. So when a practitioner or the reviewer, as the case may be, working and arriving at some matter which is not qualified, which is not modified, but exactly requires attention of the users, need to be emphasized in report. An opinion with EOM will be considered as an unmodified opinion and not a modified opinion. Other considerations: when a practitioner or the reviewer perform work under 2400 2410. A proper documentation, which is a requirement of Asset 230 as well. Proper documentation from appointment documents till the risk assessment, risk mitigation measures considered, audit of procedures identified, applied, conclusions formed, and deliverables should be well documented. Documentation standard should follow in a way that when an other professional expert read those information independently, should understand the complete matter. And documentation is a key, because going forward, that document provides us that what was the basis and the evidences we obtained to arrive at the conclusion. So it's a very key to the uh, review or audit or any other work a reviewer or an auditor perform. Written representation. A letter of representation will be called by an auditor, and the matters that will be considered into the written representation is similar, like management responsibility, auditor's responsibility, the work performed, what are the different areas into the financial information, and how management has applied the accounting policy, what are the matters considered, should form the part of the written representation. It should be always near to the date of your report, but the best practice is a letter of representation that should be the date of your deliverables, a report or opinion that we issue. So it's a very important for the review engagements. Date of the practitioner report. When a practitioner or a reviewer, when he is an auditor, will sign the report or issue his report, when he or she believes that a sufficient appropriate audit evidences are obtained, all works are done, and financial informations are prepared as per applicable reporting framework, including the notes. Management have taken their responsibilities. When it comes to management have taken their responsibility, has been confirmed and approved by the governing body as per the regulators requirement or the Companies Act requirement. Say for example, it has been approved by the audit committee and the board of directors. And once this is done, a practitioner or the reviewer should put his signature to the report. So these are again a key element when you're performing a review engagement under 2400 or 2410 is the case may be. So I think I have captured the differences as and when I have covered the various slides. But regulatory review and management specific review. Generally, 2410 comes into picture when you are an auditor of the listed entities and there is a regulatory requirement to have a review of a quarterly or the half-yearly review, as the case may be. Then, and generally, the most of the reviews goes under 2410 because follows the regulatory review. By management specific review, because generally done by another professional accountant, not by the auditor. So 2400 comes into picture. Understanding the entity and its environment, we discussed that when it comes to 2400, the responsibility of a practitioner increases to obtain more understanding around it, because it could be a new engagement, a fresh engagement for him. Reporting obligation, as I said, in 2410, the reporting goes mostly to the, because of the regulatory requirement, it gets published on the exchanges and everywhere. In 2400, it could be a management specific review, or might be some regulatory review. Report can go out, but in 2410, the responsibility increases. However, when it comes to report, in practitioner or the reviewer should clearly specify the standards which have been followed and what procedures in those standards have been applied to arrive at the conclusion. And as I said in my previous slide, a review conclusion is always a negative assurance or a limited assurance, where we highlight that the procedures we have performed and the inquiry that we have made with the company's personnel does not give us any reason to believe that whether any material misstatement, or gives any reason to believe that any material misstatement exists or does not exist, and accordingly we draft our opinion. So this is broadly the review engagement, which differentiates from the audit, and how 2400 and 2410 differentials. Again, I just repeat myself. 2400 comes into picture when we are not an auditor and work as a practitioner. But 2410 comes into a picture when you are an independent auditor of an entity and you have to perform the review of the interim financial information. Thank you. That's all from my side. Thank you so much for having this questions hearing. I would happy to take all those questions if has come and you want to ask. We'll try to answer all those questions.
विशाल जी क्वेश्चंस लगाइए.
Yes, sir.
Okay, question number 1. A Limited is a listed entity and is required to publish limited review report as per SEBI LODR regulation. It has 3 subsidiaries which is wholly owned, namely B, C, and D. D, a Section 8 company. As per SEBI LODR regulation, format for issue of audit report is prescribed for listed entities. A Limited issues audit report wherein it gives reference to regulation 33 as well as Ind AS 34. Okay. Since B and C are private limited, are they required to mention the word or give reference to regulation 33 even if it is not applicable to them? So I just answered to this question. When B and C are unlisted entity and they are getting their review done just to support the consolidation of entity A Limited, they need to highlight and emphasize on the purpose for which this review is done, like just to support the consolidation of the holding entity to submit their report under regulation 33 to the stock exchanges. So they don't need to say, okay, we have performed this review under regulation 33 because they are not obliged to do that. But when it comes to give a purpose, they should mention in a way which I just told you. When it follows next, if statutory auditor want reference to regulation 33, whether 2 limited review reports need to be prepared by auditor of B and C Limited, one containing reference to regulation 33 and other with reference to Ind AS 34. What will be answer for the limited review report to be issued for D, Section 8 company? Okay. Will the answer for issue of LR report changes if B Limited is not considered in consolidation by group auditor? Okay, I just give you the answer in overall that how does it work. So company A, which is a holding company having 3 subsidiaries. First I take B and C, which is unlisted. So as I just told, if they are performing their review to support the consolidation of the holding entity, of course, the review is performed under AS 25 or Ind AS 34 as the case may be of the applicability of the standard. In that situation, the reference to that standard should be given because the financial informations, these are interim financial informations, and prepared accordingly the recognition measurement criteria given under those standards AS 25 or 34. So that should be given. However, reference to regulation 33, B and C are not obliged to do any review under the 33. However, they are doing this review for the holding entity consolidation purposes. They should specify that this review or the results of financial information are prepared to support the consolidation at the holding entity level to discharge or to complete their responsibilities under regulation 33 of SEBI LODR. I think I hope I have answered all the various questions which are covered in question number 1. I move to question number 2. In a review, since a conclusion is given, then why are you using the term opinion with the term unmodified, qualified, adverse, or disclaimer? Okay. The question is, when it's a conclusion, you have to use the word the qualified conclusion, adverse conclusion, or the disclaimer conclusion. So it would be conclusion, not an opinion. I can see next Q3 only. Is there any question?
No,
Any
there
question
would
is
not.
कोई question था sir?
No, there are no further questions, Pratik. Thank you very much for answering them and taking us through the SRS 2400 and 2410 on behalf of WRC. I thank you. Hitarth, are you there? I think he's not there. So, Pratik, on behalf of WRC, we thank you for. हाँ?
So कुछ पूछा आपने?
नहीं.
Okay, sir.
So we thank you for sparing your valuable time and discussing these two standards. I have always, I believe, and I very firmly believe that making presentation on the standards on audit is never easy, and that also the ones which are the non-assurance, which something which is not linked directly to the audit practice. But something like a limited review engagement or other review services, and because they are the standards which are, I would say, very less looked into, referred to, and therefore we speakers like you have to take a lot of efforts in explaining everything right from scratch, and you did a wonderful job on behalf of WRC. I thank you once again. And friends, that's it from our side, and we shall remain in touch. Have a great weekend. Thank you everybody.
Thank you, sir. Thank you.
Thank you, Dharmendra ji.
Thank you for inviting me on this wonderful session, which has shared a lot of knowledge from my perspective, because I'm not into this specific area. But yeah, it was enlightening and wonderful knowledge session. Thank you.
Yeah. Thank you. Thanks. Thank you.
So much, everyone. Thanks.